Welcome to our eSignal weekly Forex and futures forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. I kept this slide in here before we get to the markets. I want to show it to you again. It's so important that you have a static trading plan, that you have a trading plan based on your trading methodology that you can measure. Once you have that, then you can forward test it in the markets to see if that plan works. You want to keep track of all those trades, and that's what you call a benchmark. Once you have a benchmark, then you can make that determination whether you're going to risk your hard-earned money in the markets or not. First market we're going to cover today is the Australian US dollar. Aussie dollar down hard on Friday in sympathy with that strong US dollar. You had the US jobs number come out, almost 300,000 jobs added. Big number. A game changer in these markets in many ways, particularly the commodity markets, and we're going to get to that shortly. Aussie US dollar, we said last week, we're interested in the short side, very short term, but we're really not interested in pressing this market into support. And you can see that support level starting to hold up here. Pretty good down day, but you're right into the teeth of support right now. We're definitely not on the long side either, so we're kind of in a neutral stance here in the Australian dollar. If you look at the big picture, we pan out to a monthly chart, and you could see there, well, hey, your grand pattern is still bullish actually. You could take the low from 2008 up to there, and you've only retraced 2/3 of that. So as long as that long-term 2/3 level is holding for us, we're really not interested in pressing this market on the short side. A little too soon to get on the long side either. Even on the daily chart, you can see it's still a succession of lower highs, right? So nothing to do here. Next market we'll take a look at will be the dollar Swiss. Dollar Swiss just keeps on chugging higher. Look at that big up day. You took out any kind of resistance. It's created from the 5/8 and 2/3 level here, and dollar Swiss just keeps on chugging higher. And as we said all the way down here back in January, hey, we like the dollar against the Swiss. We saw this big thrust down as a buying opportunity, and really that's what it proved to be. So we're staying on the bull side here. We still like buying dips in dollar Swiss. Dollar index, the next market. There you can see the dollar index jumped above that 50% level. As we said last week, we still like dollar index on the upside. We think it's going to par, and we think you'll get it even beyond that. 102 and what is that? 102 3/4 or so. So we think there's still plenty of room on the upside. The dollar index has been so good to us from an investment standpoint, from a long-term trader standpoint, and when you get a market that's just going your way, you just have to let it keep on going, and that's really one of the secrets of trading, and it's one of the secrets in life. You just have to be relaxed enough to let that guy go, and that's what we've done with the dollar index all along, and we think there's plenty of upside there too. We talked about this, I think last year too. We said, well, what's going to fuel the next leg up in the dollar index? And we said interest rates in the U.S., and we're going to get to that market too. But yeah, we still think there's plenty of room on the upside here, just as we think there's plenty of room on the downside here in the euro. Euro testing that long-term support level right here. We'd have to go all the way out to monthly chart to see where that support level came from. We talked about it last week. That's the 2/3 level of this entire move of the euro rally that started back in 2000. So boy, you've already retraced 2/3 of that. We just think the way it's set up, we think longer term you'll get beyond that level. We think you'll see even more downside here. So we're still in the sell the rally camp in the euro. Of course, as always, we monitor it on the shorter term too, and that's your daily, and you can just see the momentum down on that. And given that bearish momentum, we see no reason to not continue to sell rallies, both short term, intermediate term, long term, in the euro. We think overall long term there's a lot more downside here. Here's the gold market coming up next. We talked about gold last week. We said, hey, it's got to hold up here, and it didn't. We're pretty bearish on gold now. You could see how big of a down day you had on Friday. You just really trounced any gold bulls you had left. The hard part about this, well, the reality of this is when you look at where gold's priced now, and you look back, you You look back 3 or 4 months, and no matter how well of a trader you were, no matter how well positioned you were in gold, you're probably underwater on it right now. And gang, that's what makes markets move. When the traders are underwater, they're nervous, they're more prone to exit that trade. Selling begets selling is where I'm going with that. So we think that there's a lot more downside here, and given the primary pattern is still lower here, we think that gold breaks out of this pennant, I guess that we could call it, that it's in, and you're going to see more downside here. Level to watch in the gold is going to be right around the 2014 lows here, 1145 or so. That's going to be the next key level. If it slices below there, we think it goes a lot lower. Given the outlook in U.S. interest rates, though, it'd be awful hard to turn the gold around here. So nothing new really for us longer term. We're still in the bear camp. Still selling rallies here. Next market, dollar yen. There you go, dollar yen jumping higher. What we said last week, we wouldn't be surprised if it probed above resistance, and even got as high as 125 or so. And that's what you saw last week. You had some more upside. Dollar yen making a higher high. We still like buying dips there. Although again, if you look at the percentage move higher in dollar yen relative to lower in the euro, just Friday alone, just yesterday alone, again, there's easier pockets to pick here than going long dollar yen. But if you took buy signals in dollar yen, who's complaining? You made money. Take a look at the 10-year note, and we covered this last week, and I said if you take out this level, that's going to mean higher interest rates in the States. It's going to mean a more normalization of the global economy. Also, you had a big U.S. employment number. That's bullish for the U.S. economy. And I'll tell you what's bullish for the U.S. economy overall is going to be bullish for the Chinese economy as well. Looking out globally, it's even going to be beneficial for the European economy also. So this trend line, a big deal here. Let's pan all the way out to a weekly now. And that, as I said last week, that means you're going to see higher rates in the United States, and that's going to mean a normalization of the global economy. So that's a big deal. Interest rates jumping finally. Bond market going down. We'll show you the chart, the mirror image of this chart, which is just straight rates, and you'll be able to see those rates. You'll be able to see the levels. There's the important level that we talked about. It got above there, and rates are at 2.25 now after bottoming just above 1.5 just a few weeks ago. So we think the big employment number portends U.S. economic strength going forward. We see higher interest rates as a function of that coming economic strength. So we think there'll be more room on the upside for the 10-year notes here for interest rates, I should say, i.e. the U.S. economy. So overall, we still like that strong dollar thesis. Nothing's changed there. As traders, we may start focusing a little bit more in commodities on the short side there now that we're seeing a clear trend in U.S. rates. Thanks again. I'm going to leave you with how Warren Buffett summarized his investment philosophy, which dovetails very nicely what we do at Trading University. Our approach is very much profiting from lack of change rather than from change. We very much believe that the cycles that these markets create lend themselves to continuity, so we see what's happening now as the most likely direction for what's going to continue to happen tomorrow. Thank you so much, and we'll see you next week.